Hey everybody, Brett Rice, CoreVISION Financial Group, coming to you today with another video in our series on financial topics. Hey, go to our YouTube page and subscribe so you're notified when we post a new video. We're posting at least one video a month, so you want to be notified when we post those to get this great content we're putting out. So today we're joined by Beau Browning, a partner here at coreVISION, and we're going to talk about some investment pitfalls, and we're going to just talk through some of those. So thanks for joining us, Beau.
Thanks, Brett. This seems to be a recurring topic for me. I'm excited to talk about kind of behavioral investing, and I just think it's something that all of us as human beings have to be reminded of, probably to the tune of at least once a year. So that's probably why this keeps coming back up.
Because this isn't the first podcast you've done on...
It might be our second or third.
Yeah, it might be the third.
Yeah. So
to where you get involved into the behavioral or the psychology, right? Of, hey, why do people feel certain ways, or why do they want to react a certain way, and do those things.
And innately, that's hard for. It's not like you're just like, hey, I really like to not be that way, and it just flips a switch and it changes. No, it's hard for us as human beings to change that behavior. So we could talk through the ability to maybe give yourself some coaching pointers along your investing journey. So thanks for having me.
Introduce yourself.
Yeah, absolutely. I'm Beau Browning. As Brett said, partner here at coreVISION. It's 2025 now, Brett, and I've been in the industry for 20 years. I can't believe I'm saying that. So it feels like yesterday that I graduated from college, and 20 years has flown by. That got two little girls at home, married to Mary, my wife. And yeah, those are the people at home that I try to do this every day for.
Glad to hear that. Thanks for joining us. I've loved doing these podcasts. This is our 56th podcast.
Wow, that's racking up.
Pretty soon, a couple of years, we'll be celebrating 100. The world did we get here?
Yeah. We'll have to have some confetti that day.
Yep, for sure. We'll make a big mess in here.
Absolutely.
All right, so let's talk about some of the behavioral pitfalls that are common with investors.
So I think number one is people get a little too focused on rate of return. The expectations, especially for the long run, can be a little high. And that's really the first thing that I think of in regards to behavioral coaching is, do you understand what a reasonable rate of return looks like and what the compounding of that number can be long term?
Yeah, and I think a lot of times we rely on our coworkers to give us, to be our expert, or social media. I mean, if you watch social media, you just see so much bad information out there.
Yes.
That a lot of people say, well, I heard my coworker says they're getting 20% every year. And it's like, well, you do know that.
Well, and it's easy also to fall into recency bias. That's another one that we can discuss. And, the last 2 years in the stock market have been really good. 2023, oddly, was good with really a lot of bad news and not the greatest earnings. 2024 was excellent with good earnings, great news. And now we're kind of getting into that cycle where bad news is actually good news, and that's kind of turned its tide. But all of that builds up, the ups and downs, to a reasonable expected rate of return. And, historically, stocks, especially let's focus on U.S. stocks and U.S. bonds, but U.S. stocks have done around 9% average annual if you go back 100 years. Bonds are closer to 5%. They have a much lower standard deviation or swings from that standpoint. But those returns, they're black and white. They're there in print. You can see them. We know that most portfolios are likely to do somewhere between 5 and 10% average annual long term.
So a lot of times, when we sit down to do financial planning, we're using like a 6.5 number, right? It's pretty conservative. It's, we think over long-term periods of time, 20, 30, 40 years, we're easily going to get 6.5%.
Correct. And it always depends on your mix of stocks and bonds. But most likely our investors are somewhere between a 50-50 stock bond portfolio and a 95-5 stock bond portfolio. So again, they're going to fall within that range of return of probably 6 to 10%. Well, if we skew them on the lower end and they have more money than we've expected in retirement, that's good for them. I think they would rather be in that position than too little money.
Right. Now, I don't know your philosophy on this, but, while the rate of return is important, the contribution rate is, equally as important, if not more important.
Absolutely. And what you can't get back is time in the market. So the sooner you begin a contribution, now that doesn't mean somebody 55 has to go, oh, I've missed 30 years of contributing. Start today. The longer you do that process, the more impactful that is. A couple $100 starting at age 25 all the way through 65, it amounts to a massive number. We've all seen some of those statistics, and sometimes social media can be good for that because you can see those out there. A couple $100 a month that I start at age 25, by the time I'm 60, I got $1 million. That is not untrue. That is very possible. And so contributing, especially as a starting point, I mean, we all have zero when we start. The contribution matters more when your value and balance is lower than when it obviously gets higher. The impact of the swing in the market becomes more impactful when you get to a much larger number. But those dollars that you add in are equally, if not more important, especially at the beginning.
And a second ago, you talked about the stock to bond ratio.
Yeah.
Let's talk about what's the importance of that in the diversified portfolio.
Yes.
For people that, say, oh, I don't want to be, all in the market or, because we have all those conversations.
Yeah.
People don't understand, well, what do you mean by diversified? That means I need to have some money with you and some money with somebody else.
Yep.
Or do I, so just talk through that.
And history gives us a great insight to that because all of that, we talked about expected rate of return. We can kind of go back to what kind of income does somebody need or what type of retirement are they looking for, which will determine how much money they need in retirement. Then we back into, okay, an expected rate of return of 7% or 8% is going to get you here. Are you willing to take on that risk? We can look at historical portfolios, how they performed in up markets, down markets. You can look now at Great Depression. You could look at what happened during the Great Recession, in 2008.
The Great Financial Crisis.
Yes. So what happened in, 2000 to 2002 period where the market was pretty shaky. But also during bull markets, what happened in the tech bubble in the late 90s? What happened maybe these past couple of years where the market was on fire? And find out whether you're comfortable with that. One of the questions you had written down before coming on this podcast was, what kind of determines your risk tolerance? We have questionnaires that will help find the right style mix for you. But more than anything, what's most important, I think, is experience. You almost have to kind of find your way a little bit, especially maybe in your first 10, 15, 20 years of investing. Then you kind of hone that in as you get closer to retirement. You kind of understand what risk you're willing to take because you understand the ebbs and the flows of the market. So kind of getting that experience of, hey, here's what a, 80% stock, 20% bond portfolio does. I kind of have that experience of what those fluctuations look like in both an up cycle and a down cycle. But the importance of diversity, you had mentioned. We don't know which asset class is going to be on top. Last decade tends to seem like large cap growth technology stocks are always going to remain on top, and that, I guess, might well be so. But history teaches us that those asset classes trade that spot a lot. Early in the 2000s, it was emerging markets. They've gone quiet for a long while now. Doesn't mean they can't be on top again. It has to be the right environment. But having an allocation to each one of those sectors is important in our eyes so that you're not putting all your eggs in one basket. It may mute the return a little bit on the upside. Your upside potential might be a little bit more capped, but your downside protection should, in theory, be better as well because you're likely to be less allocated to some asset classes that might be number one, but also number 20. You're kind of trying to hit singles and doubles and not triples and home runs, if that makes sense. There's a time and a place for that.
Yeah.
But everybody's risk tolerance will dictate that.
Yeah, and through the diversification, you should see part of that home run in your returns, right?
Absolutely. You're going to see some big ones and see some that are toward
You're going to see the home runs, the touchdowns, not all the fumbles either,
Yes.
right? So
Yep.
there's the trade-off like you're talking about there. But it's important for people to understand, when we talk about diversification, the asset classes, large, small, mid-cap, foreign, all the ones you just talked about. A little bit of exposure to some of them can change your risk tolerance, right? It can be that we're
Absolutely. Yeah.
understanding that is important for everybody as well.
And again, the discipline, after you've got that diversification, the discipline to rebalance that portfolio. You've chosen a 75% stock, 25% bond portfolio, for an example. Rebalance to that at least once a year because things can get out of whack. Large cap growth ascends, it goes up 35%, emerging markets goes up 2%. Well, what that would tell you is let's take a little bit of profit from the large cap growth sector and buy a little bit more of the emerging markets so that our portfolio stays in balance. And again, we don't have major overweightings in some asset classes. We still predominantly tend to invest in U.S. We tend to be heavier large cap than anything else. That's played out very well for us. But we always still like to have some piece of each of those puzzles to make sure that our diversification is broad and meaningful.
You just briefly touched on this, but let's talk about the emotional decision-making impact.
Yeah.
Like when you're talking about, an asset class going up and, hey, it's time to rebalance, the emotional decision-making of being like, we're going to trim that off and we're going to bring it back within tolerance, where some people are like, well, it's still going up.
Yeah.
We want to keep the money in that. So, just briefly just discuss that emotional decision-making.
Yeah, sometimes that is, it can be a tough thing because you're trying to chase as much yield or return from that asset class as it's running up. As long as those changes are being made on a frequent enough basis, like at least once a year, we usually say, you are likely to not have major swings in there that are so drastic anyway. Now, if you let a portfolio go 5-10 years without rebalancing, that emotional decision is going to become even harder. Because if that asset class has continued to grow for what is seemingly undetermined amount of time, it's going to be harder to get rid of that. But also, that's setting you up for that asset class to likely have the hardest fall as well. That's just, kind of the nature of the market.
You touched base on the questionnaires we use to develop the risk tolerance. I'm talking to clients a lot of times. I'm like, are you going to be able to sleep at night? If, you tell us this is your risk tolerance, your sheet says it's this. But, not only on when the market goes down, but when the market goes up, are you going to be able to sleep knowing that you missed out on that? Right? And then when it crashes, are you going to be able to sleep knowing that because of your portfolio, your loss is going to be this number or whatever?
You're exactly right. This is a great point because I think a lot of us, all of us as humans, and this isn't exclusive to just our clients or investors in general, but it's just all of us as humans. Anybody that has invested money wants to make money and not lose any. The reality is the market goes up and down. It wouldn't be the market and it wouldn't have 9% average annual rates of return if it didn't fluctuate. It would just be like putting your money in a bank. So we have to be able to understand that is going to happen. That's why I almost talk, after going through those questionnaires, it's talking back to what is the necessary rate of return that we kind of need for you to grow live that same lifestyle you've grown accustomed to, and how can we achieve that? What portfolio mix achieves that? Is it 60% stock? Is it 80? Is it 100? What type of return do we need? Not what we'd like, which we'd all like double digits all the time, but will 7% get me there? Can I stomach what swings come with a 7% rate of return? Going through that, showing people and just educating them, I think helps ease that pain of losing sleep at night.
To kind of piggyback on that, we like to think that as financial advisors and people's professional advisor in this to help eliminate those emotional decision making? Like, what role do you think the advisor plays in that?
So, wildly enough, I mean, I went to college, got a degree in economics. Okay, I come out, I want to be a financial advisor. What this has morphed into more than anything is psychology. Being a psychologist or behavioral coach to make sure that people don't make mistakes. We can almost be our own worst enemy when we make irrational mistakes or make moves in the stock market too quickly or on an emotional whim, all of those types of things. Trying to take as much of that out of the hands of the investor and putting it in our hands, because we aren't going to make those decisions emotionally. We're going to make those rationally based on theory and what we've been taught from a rebalancing standpoint, diversification, doing all of those things the way that we know leads to the best outcome. We are going to stick to that plan. And, you know, you and I were talking about this a little bit beforehand, but Vanguard has done studies. I think a couple of other companies, you can Google it. The value of an advisor is traditionally 3% better rate of return than the average investor investing their own money in their own way. Also inherently comes with emotional moves. The advisor is likely not going to make those moves. There's a lot of buy and hold strategy behind that thought with rebalancing, etc. And those returns are going to look 3% better on an average annual basis over a 10-year period than somebody without an advisor. So I'm proud of that fact, because we want to enhance the value, bring a rate of return for clients, because we know they are paying us. They are paying us to make those moves and keep them disciplined so that ultimately they end up with the best outcome.
Right. And, you know, we're looking at it from, here's the information they've given us: time horizon, risk tolerance, you know, those things. So when it's time to sit down and have that conversation, we're like, well, you've told us this is your time horizon. Has any of that changed? If not, then we should be staying on the same course.
Correct.
And no deviations from that. And I think, you know, a lot of times that's what we do, is we just, you know, take all the news that's going on around us, and we say, you know, how does that impact your time horizon, your risk tolerance, right? If there's no impact, there's no reason for us to change.
That's exactly right. And you and I were mentioning too, you know, short-term news or events, geopolitical events, or maybe the latest craze like AI is right now, or in any of those examples, the internet back in the early 90s, you know, or excuse me, the late 90s, any of those things, trying to always make sure that investors understand what's going on in the market, understand what they own, why they own it, what we are allocated to, what is noise, what isn't noise. And I think continual communication and education to the investor empowers them more to understand that, hey, when things go sideways, if we do these things, this is how we end up with the best outcome. And it's not just sit and do nothing, but it's also don't make every single change in your portfolio or pull everything out and go to cash or buy the latest, crazed tech stock. It is being disciplined, understanding that the market will recover and will rebound. It has always done one thing. At some point in the future, it is set an all-time high again. And that will always be the case as we move forward in the market, that we will see the market go down, but it will ultimately rebound to set new highs in the future.
We've touched on it a couple of times, but, you know, we watch a lot of financial news. We see all the social media stuff. How can we help investors say, you know, to understand, hey, when you go look at this, there's red everywhere. How do we help them say to themselves, hey, this isn't changing my goals. This isn't changing my time horizon. You know, when there's like all this pressure, you know, everybody, like you just talk about the hot tech stock.
Yeah.
Right? You're going to get pressure. People are going to be like, oh, I can't believe you didn't buy that.
It's in front of people's face every single day. Yeah, we all see it, especially now with social media.
For sure.
Get caught scrolling, you're going to see something. I do think when you talk about people that might look at it daily, sometimes the question that I would maybe propose to those people is, does it change your daily habit? And weekly or monthly? Does it change the habit? Does it change your spending? Did it change your income? Did it make any impact on your actual lifestyle? Thus, looking at it is perfectly fine. Logging into your account, understanding what the Dow or the NASDAQ or the S&P did that day, perfectly fine. Making decisions that day based off of that, or even moving into the next week or month, are likely not the best thing, because the market is moving at all times and up and downs happen. And we all have to be disciplined to say, hey, it's not making a change in my lifestyle or impacting me right now. There's really nothing I need to do about it.
Two things left to touch base on. Let's talk about the impact of trading frequency on your return.
Yeah, and you and I just touched on this before, and I think a lot of this goes back into that Vanguard study. The impact is frequency of trading can have a detrimental impact to your ultimate rate of return. When you are researching a stock, or we are, or ETF or whatnot, the thought process is, I want to buy something that I believe is undervalued or enhances my portfolio or diversifies it, any of those, and I'm going to own that for an extended period of time. Doesn't need forever, but it might mean multiple years. Traditionally, you're not going to gain a whole lot of benefit on short-term gain and loss either. Now, if you have found something that you think might have a short-term impact, that can be okay. You just have to understand the inherent risk with that. And I tend to believe we all fall prey to some of that social media and the hype and the next best thing. And look at what happened to some of the meme stocks like, AMC or GameStop or whatever. Not really robust companies, and they're getting this run up at stock prices because people are literally just putting out communication on it. People are buying it up. The price accelerates. And then ultimately, when a lot of those shares are sold, the price plummets. And so which side of that coin do you want to be on? I would rather just stay out of that whole thing, because it takes a lot of vigilance to pay attention to that and do well with that kind of strategy. That's why I think long term that you succeed with diversification, buy and hold, doing those things that we've been taught are good for the best possible outcome. Rebalancing, diversification, I will reiterate that, and buy and hold, those strategies tend to result in the best outcome. Maybe not in a 2-month window, but certainly over a 10-year period.
The one thing left to talk about is timing the market.
Yeah.
And kind of your last conversation rolled right into that, right?
Yeah.
Talking about hot stocks, talking about long-term investing.
Yeah.
One of the things the reason that advisors be the average investor is because of the buy and hold strategy you just touched on.
Yeah. And I can actually have you talk to it, because you've brought it up to me multiple times. We talked about dollar cost averaging versus not dollar cost averaging. Now, it does depend on which time horizon that you look at. And I would tend to say for younger investors, especially ones that have enough risk appetite, there's really no need for dollar cost averaging. I feel like there is a much bigger advantage to putting those funds to work pretty quickly.
Yeah.
As you get a little bit older, and I don't know what that marker is, but let's say 50 and older, it becomes a little harder to pull that trigger. So I'm okay doing some dollar cost averaging in portfolios, just from the simple fact that I think it brings a little bit of peace of mind. Now, if you look at those historical returns on a rolling basis, you found the history out, so I'll have you talk about it.
Yeah. I mean, it just says over time, the lump sum investing beats dollar cost averaging. But you understand that they're different types of investing.
Yes.
Right? dollar cost averaging is somebody who's putting in.
Monthly contributions, you have to dollar cost average. Yeah, there is no choice.
Yes. So, I mean, some fortunate that that's just how you're going to invest.
Absolutely.
Your 401k, your employer plan, you're going to do dollar cost average.
Right.
Lump sum investing, is different. You have something, an inheritance or a winning or something. Hey, now all of a sudden I got this amount of money. Should I dollar cost average it in, or should I put it all in right now?
Yeah. And a few other factors can come into play. Right now is a good one that we could talk about. Cash is actually paying something. Cash hasn't paid anything for 20 years. 2004 was really the last time it was anywhere remotely near here. It paid for that 5% rate pretty much through about half of 2023 to half of 2024. Now we're in the 4% range. It's easier for us, again, psychologically, to dollar cost average something that's making money while it's sitting there versus when interest rates were at the floor forever, for almost a decade, right? 2007 to 17, seemed like. Dollar cost averaging is significantly harder with a lump sum of money because it's not really earning you anything while you're doing it. Yeah. Of course, we're all afraid like the next big drop is around the corner. That, I think, inherently is the fear. Sometimes we have to coach ourselves out of that if we had a longer time horizon. Now, if you say, I only want to invest this money for 3 years, you start have to think about, is there a big drop around the window or around the corner? Versus, I've got 10, 15, 20 years to invest this money. We don't have to worry as much about the big drop is around the corner. It'll likely exceed that big drop within those few years anyway.
Anything we didn't touch on that you want to make sure we do touch on during this conversation?
I don't think so. I think that this is, the article I wrote should be coming out soon. Might come out before this video, so I'll preface that. But I love this topic because I like to give everybody a refresher on the discipline of investing. If we are all logical, rational, and disciplined, it's a hard thing to be. Like all of us literally have emotions, and that part we can't take out of ourselves. It's making sure that those emotions don't turn into a reactive action. We want to be proactive always, but inaction can be just as powerful, if not more, in investing than action can be when it comes to manipulating the portfolio and trying to achieve something that might go beyond what your goal actually is. You can do yourself a better service by being patient.
Yeah, a lot of times people just analysis paralysis, right? You're so worried about all these different aspects of it. You're like, oh, I can't wait. I can't do it now. This is it's like, just put it in there.
Yes.
And let it do what it does.
Yes.
I mean, there's a lot of factors involved.
Sure.
Research shows.
So if you've got the time horizon, you're going to be significantly happier after a 10-year window than you ever would leaving it under a rock or in your mattress or earning, in your savings account. Yeah.
So let's talk about inflation and how it works with investing and how people should perceive their returns with inflation.
Yeah, thanks for bringing that up because you and I have been focusing a lot on that rate of return. Well, let's talk about net rate of return. So inflation erodes your purchasing power. We already know that, right? That is, we can't buy the same goods tomorrow that we bought today with the same amount of dollars. We've got to have more. When you're looking at it on a rate of return standpoint, historical inflation is usually between 2 and 3%. Fed always wants it down to 2. It never seems to get there. We've trended toward closer to 3 over a longer period of time. I think what we've built into most of our models is around 2.75%. Well, let's look at, if you're achieving a 8% rate of return on your investments over time, your net weighted for inflation rate of return is 2 to 3% lower than that, so 5 to 6. That's why that comes into play, because we always encourage people to live off of 3 to 4% of their total balance as an income level in retirement. We know that it will be able to sustain with inflation and their withdrawals and likely maintain that principal balance from when they retired. That's why it's important.
Yeah, a lot of times I don't think we hear about inflation in your purchasing while you're working. I mean, we got to take that into account as our savings goals, right? So a lot of times we talk about people 4% withdrawal rate. 2.5% inflation, because that's how we get to that 6.5 number. That's the minimum number we want to try to hit.
Yeah.
Right? To get you to where you want to.
Well, I mean, the last 3 years, all of us can attest to the grocery bill went from, I don't know, you're buying for a family of 4. I feel like mine went from, $200 a week to like $300 a week. And it gets, those are meaningful, impactful, real dollars.
Right. All right. Well, thanks for joining us. Fantastic topic. We could talk about this all day long.
Yes, we really could.
And we've had dozens of conversations about it.
Yeah. Well, I appreciate you having me on. Thanks again. I look forward to doing some more of these in the future. So, Happy New Year.
Happy New Year. Again, everybody, Brett Rice, coreVISION Financial Group, Beau Browning, our guest today. Hey, please go to our YouTube page and subscribe. Get notified when we post new videos. Thanks for your time.